Hi guys, welcome back to Compounding Everything. For those of you that are new here, my name is Chris and this is the channel that is dedicated to discussing all things investing, finance and business, helping you build and grow a long-term successful portfolio. Now, in this video, we're going to be discussing a security I've spent many years watching and admiring from afar. Coincidentally, it's also the video that has been requested the most on this channel. Now, because I will be spending a lot of time in this video talking about why I like this company, I do have to say that this video is for entertainment purposes only, and in no way should be considered financial advice. Now, of course, if you haven't already, feel free to click that subscribe button and the little notification bell next to it so you can stay up to date on all of my latest videos. Anyway, let's get this one started. So, as you guys have seen from the title of this video, the company we're talking about today is Credit Corp Group, which is Australia's largest debt collection company. Credit Corp, up until February, was actually also one of the largest 50 companies listed on the ASX. So, to keep things simple, I'm going to break this video up into 3 different parts. The first is we're going to talk about the books themselves and try and figure out where these guys stand fundamentally. Then we're going to move across to why I like this company moving forward. And then to finish up, we're going to talk about if I've purchased this stock yet or not. For those of you that may not have looked into these guys before, they are a serious long-term performer. So let's take a minute to break down the books and gain a bit of an understanding as to how they've earned that title. So firstly, their revenue has grown significantly year on year from $174 million in 2014 to $324 million in 2019. Not only that, operating profit over the same period has doubled from $51 million in 2014 to $113 million in 2019. And then for the same period, net profit has also increased from $34 million to $75 million. Now, when we move on to earnings per share, we can see they are following the same trend of nearly 100% gains between 2014 and 2019. However, what I personally find impressive is their return on equity and return on invested capital, which averaged over the same period is just over 20% for ROE and just over 10% for ROIC. Which then brings us on to cash. They were sitting on just over $22 million in cash. However, it is worth mentioning here that Credit Corp recently completed capital raising via an institutional placement of $120 million and a share purchase plan of $35 million, which does leave them in a great position short term. Now, moving on to debt, which is a little high, however, very much a necessary evil in this sector, considering that they are required to be consistently purchasing more debt ledgers. And at the end of the day, as long as the debt is managed well, which in this case it is, then I'm not overly concerned. Now, all of this is surrounded by a solid management team with a proven track record, which is also impressive. I mean, you guys can see here that the books are pretty neat. There aren't too many red flags when looking back. However, it is worth mentioning what I consider to be the only elephant in the room. Now, although extremely unlikely, it is possible that Credit Corp could be crippled if our economy were to see a significant downfall for a prolonged period of time. And I guess to break that down in simple terms, if the majority of debtors aren't able to service payments, let's say over a 1 to 3 year period, then Credit Corp might be left holding a big bag of bad debt. Now, the chances of that happening, in my opinion, are very slim. Credit Corp's debt could almost be covered by the capital raising they completed earlier in the year. Not to mention cash in the bank and operating profits. So my guess would be, in the case of a depression or a very bad recession, Credit Corp would unlikely be in a position where they would be forced to close their doors. What is more likely is that they would downsize significantly and come out the other side, which is kind of something similar to what you've seen in Flight Centre and Webjet over the last 3 months, with significant downsizing and cost cutting. So anyway, we've covered the books and some of the risk involved around Credit Corp short term. So what is it that I actually love about this company long term? Well, the first thing is you absolutely destroying that like button. Did you know that it's 370 times more likely that after you press that like button, your stocks will go to the moon? Anyway, whether you want to do that or not is up to you. I mean, come on, look at the returns. Anyway, that's your choice. We can now return to regular scheduling. Like I was saying, what do I love about Credit Corp? Well, to start with, these guys are the biggest and the best in their field. Not to mention they've come back from a recession before. That means that they aren't sort of sitting around a table, drawing up a game plan from scratch. They already kind of have it. And not to mention, they have an incredible moat, which you would think in this industry is nearly impossible to obtain. Still, nobody has come close to touching them in many, many years. And that brings me to my next point, which is that they can manage their debt and have a decent amount of cash on the sidelines at the moment. Now, of course, that amount isn't endless by any means. However, one of the benefits to running a very profitable company that grows its return on equity and revenue year on year is that you're generally speaking going to be in a better position when reaching these types of situations. And honestly, when all of this is over, their service model will still be very much essential. Although they are the hardest hit in recessions, they also make the most coming out of them. And you might ask why, and that is mainly because these guys are very good at purchasing debt for cents on the dollar and then collecting it. And debt is a profitable game long term if run by an organization that knows what they are doing. Before I carry on here, for those interested, it is worth noting that those courageous enough to buy this security in 2009 after the GFC and hold it over the last 11 years would have achieved a return of 7,100% plus dividend income. Of course, that is from the trough of 2009 to the peak of 2020 pre-COVID, but very impressive returns nonetheless. So, I mean, we've spoken about the books and what I like about them. So let's talk about if I've purchased this company or not since my last update. I mean, like most of you guys right now, a large portion of my portfolio is cash, and I'd love an excuse to put that money to work. So have I actually done that? Well, when researching a security, I like to create, I guess what you could call a range of what I believe is a fair valuation for that company. Like most listed companies at the time, throughout 2018 and 2019, when I first created this range, Credit Corp was significantly above that valuation. So when we skip forward to the start of this year, I was busy getting to work trying to find where I thought there could be potential value in the market if we were to see a correction. And one of those companies that happened to come up on my list again was Credit Corp. In fact, in a list of roughly 30 companies, give or take, that I had found at the time, Credit Corp was firmly placed in the top 5. So I'd set my range and threw my post-it note up on my monitor and thought, great, well, I'm going to sit here and I'll wait to see if this does happen throughout March or April. And then early March, Credit Corp's share price had dropped from roughly $36, I think it was at the time, to $16, which was over a 50% reduction. And at that stage, this was still nowhere near where I needed them to be. So in the following week, I was watching them get closer and closer towards my buy price. And then on the 23rd of March, the significant drop ended at $6.25 per share. Now, all in all, their share price had dropped well over 80% at that time. And relatively speaking, on that day, I remember being very close to hitting the top side of my range. However, it didn't quite get there, and unfortunately the next day it started going back up and I was left on the sidelines. So no, I haven't bought in just yet. Now I want to make something clear here because I get this question all the time, and it goes something like, but Chris, why didn't you just buy? I mean, their share price has gone up threefold since that low on the 23rd of March of $6.25. Clearly you made the wrong choice. And although on the surface that seems like a fair comment to make, it's actually completely irrational from a fundamental standpoint. One of the rules I always try to teach you on this channel is sticking to your plan. This time it went up, but if I would have bought in outside of my parameters that I was comfortable with and it went down, I'm left in a very difficult place there and I cannot justify myself, and that's solely because I would have purchased at a price that I thought was overvalued. Now, if I do purchase at a price that is within my range, once the purchase is complete, I have no interest in what the share price is doing short term. I'm watching company announcements and treating my investment like a business, not a trade. Now, of course, not to be biased, there is another fair argument that could be made here, which is that my valuations possibly weren't correct. And that is possible, but it's very much a personal choice. In this situation, I had to take into account several variables. One was the valuation of their debt ledger, more commonly known as their PDL. Another was their fundamentals, and of course, the possible outcomes when it came to COVID-19. And that's why my range was so tight at the time and very much not negotiable. However, as usual, there is one thing I would change if I could go back in time. I've mentioned to you guys many times in the past that 5% of my portfolio is for medium to high probability speculative plays. And the mistake I made this time around was not looking at the company through that lens. I was looking at it as a fundamental investment solely. I didn't think, well, I'll buy this inside of my speculative portfolio. And if I was presented with that same opportunity again, I would definitely reconsider my position there. However, I still wouldn't go back and buy at 625 with any significant part of my portfolio. So where to from here? Well, it's simple. I'll reevaluate my range every quarter and wait for entry. And if I never get it, that's fine. There will always be more opportunities somewhere else. There always is. Commonly, the hardest part about long-term fundamental investing is patience. I mean, even if you take the long-term part of that equation off the table, the hardest part about investing, period, is patience. Now, before I end this video, I hope you guys did enjoy my analysis of Credit Corp Group. I know I didn't go into detail on what my valuation amount was. That was a very deliberate choice. It is a personal thing to value a company in this situation. Now, if we were valuing a bread and butter company, it would be different. However, there is a massive variable in the valuation of Credit Corp Group or any collections agency, and that is what you believe their ledgers are worth. And that's a very hard thing to calculate. In fact, it's almost impossible to know unless you're inside of those walls because the information isn't up to date that is released to investors like us. So I will say that at $6.25 or thereabouts at the low, we weren't at that point yet. We were getting close to the top of my range. However, the bottom of my range was quite a way off, and that's where I'm always most comfortable buying. In saying that, there is a reason I have the range, and that is normally because I will dollar cost average in from once I hit the top of it. So if I would have got there, I would have started, but we didn't. So anyway, guys, I hope you understand why I didn't give that exact amount. It's just not something that would be productive me handing out to you guys at this point in time. Now, moving on from that, I did want to mention for those of you watching my weekly podcast here on YouTube, from next week, it will become a video podcast for the entire length of each episode. And like I said last week, every month or two, we'll have an episode that is dedicated to answering your questions. So please feel free to type them in the comment section below in any of my videos, and I will add them to my list. Anyway, guys, if you haven't already, consider pressing that subscribe button and the little notification bell next to it. And also feel free to absolutely destroy that like button. Remember, it will go to the moon. Anyway, guys, thanks for watching this video, and I'll see you in the next episode. Cheers.